A trustworthy source of credit is a crucial financial tool for many of us, whether it's to pay for our schooling, buy a new automobile, or pay for an item of unexpected expenditure. However, without effective financial management, debts can quickly accumulate, leaving you feeling overwhelmed by your financial condition. That's why, before you take out a loan or borrow money from anyone, whether it's a family member or a bank, you should stop and ask yourself these 13 crucial questions. Are you curious to learn more? Please keep watching if you are. Hello and welcome back to our channel, Upstep Financial. Please subscribe to the channel and switch on alerts to receive updates of new uploads. First, ask yourself, what am I doing this for? Make sure you understand why you're borrowing money and what you're going to do with it. Is it for a single purchase, such as a new sofa, or a series of smaller purchases, such as groceries? Perhaps you'd like a buffer in case of an emergency, so you'll know it's there. Knowing how you'll spend the money should make it easier to manage it appropriately. It can also assist you in determining which sort of credit is ideal for you. After that, ask yourself, do you truly need it? Next, determine whether you truly require financial assistance. If you have a huge expense to cover, it may be preferable, but if it is less expensive, it would be better to wait and save. However, if you can't afford to cover unforeseen expenses, you may not have much of a choice. Borrowing money can also help spread the cost of unanticipated charges over a longer period. Let's say you need a new car for work, but don't have the money to buy one outright. So, you take out a loan to buy a car that is within your budget and repay it over a certain length of time. Because you must pay interest, the car will cost more. You're better off, though, because the loan allows you to drive to work and earn a living. Then there's the question of what is the interest rate? Another crucial issue to consider is this: almost all loans have an interest rate attached to them. This means you'll have paid back more than you borrowed by the time you're done paying them off. Take the time to examine the interest rate and determine whether it is adjustable or set, as well as search around to ensure that it is reasonable and that a better bargain is not available. Whether you're buying something with a repayment plan, such as a dishwasher, consider whether paying the interest is worth it, or if you can wait a few months and earn enough money to buy it outright, saving yourself money in the long run. Does the interest rate alter if you miss a payment now? If you don't make a payment by the due date on some loans, the interest rate may climb by 2% or more. Now ask yourself how much you're going to pay each month. Examine your financial situation to ensure that you can afford the monthly payment. Take a look at your total debt ratio of service, or the GDSR. This is the amount of your gross monthly income that you'll need to cover your basic housing expenses. You may find it challenging to afford additional expenses if your GDSR is more than 32%. Now consider this. What is the total amount you will repay? Try to figure out how much the loan will cost after you factor in all of the interest and the money you borrowed. The interest rate will be determined by the loan type. Some interest rates are set for the entire loan term. Also, think about how long you'll be paying off the debt. Some loans appear to have wonderful monthly repayments that are cheap and are well within your budget. However, this could be because the loan is spread out over a long period. Consider if you truly want to be paying for your new TV 3 years from now and whether you can afford to make such a long-term financial commitment. Will you be able to make these payments on time if your financial circumstances change? For example, if you lose your job or go on maternity leave. Is the loan secured? A secured loan typically has a lower interest rate than an unsecured loan. However, if you fail to repay the loan, the lender will have a legal claim on anything you use to secure the loan. It might be your house, car, or other valuables. Before we keep going, please make sure to hit the thumbs up button and please feel free to share your thoughts in the comments down below. Let us now continue with our list. Consider the ramifications of not repaying your debt. Ask yourself, what are the consequences of a failure to repay? This is especially significant for larger loans. Always consider the ramifications of not repaying your debt. Will there be major ramifications, such as a vehicle or property repossession, or will you be saddled with a mountain of debt that you'll never be able to repay? Keep in mind that if you have a poor credit history, you may have trouble obtaining credit in the future, which can be an issue if you want to buy a house, renew your auto insurance, or switch internet or utility providers. Now consider whether you'll be better off in the long run. Borrowing money might sometimes be advantageous in the long run. For example, you can utilize debt to make smart investments like getting a mortgage to buy a home that appreciates or receiving a student loan to pay for the schooling that will boost your earning potential. Debt can even help you save money in some cases, such as when you utilize a loan to pay for a railway season ticket. If the amount you save by purchasing a season ticket exceeds the amount you pay in interest, going into debt will have helped you save money in this case. Borrowing money might also be beneficial if you want to take advantage of limited-time bargains and deals as long as you can afford them and the interest you'll pay on top. Let's say you find a great deal on tickets or see something you need on sale, but it's a few days until payday and you don't have the funds to pay for it right now. If you have access to a scheduled overdraft, you might use it for a few days to purchase them and take advantage of the offer. You'll be charged fees if you use your pre-arranged overdraft, but you could save money in the long run. You'll have to do the arithmetic to see if this is a better deal. What type of credit should you get now? When it comes to credit, you have a lot of alternatives, including overdrafts, loans, and credit cards. It is preferable to choose credit that is appropriate for your demands and financial circumstances. Begin by studying the many types of credit and how they operate. Please leave a comment down below if you want us to make a separate video for this. What's your credit rating? Your credit score or rating shows your likelihood of obtaining credit. A high credit score might assist you in obtaining credit with higher limits and lower prices. So it's a good idea to check your credit score and, if necessary, try to improve it before applying. Keep in mind that every time you seek a loan or submit a credit application, your credit score will be temporarily lowered, whether you are accepted or not. If you're going to make many applications, spread them out over a few months to minimize the damage. However, credit isn't always detrimental to your credit score. Making on-time complete repayments to your lender will help you boost your credit score in the long run. Now, the question is, can you afford it? It's time to check if you can afford the repayments now that you know how much you need and how much it'll cost. Your monthly income and outgoings are a smart place to start. Anything paid into your bank account counts as income, such as a salary or a school loan. Your outgoings, on the other hand, are payments made from your accounts, such as rent, bills, and other living expenditures. Calculate how much money you'll have left at the end of the month to see if it'll cover your lender's repayments. If you don't, you risk accumulating debt, which can be both stressful and costly. It's also a good idea to consider how you'll handle things if something goes wrong. What happens if your employment is lost? If your student loan is late? It's critical to avoid late payments when borrowing money because they can result in fees, a lowered credit score, and even legal action. Above all, remember to only borrow as much as you can afford. You may find it challenging to afford additional expenses if your gross debt service ratio is more than 32%. And that's it for today's video. Please make sure to subscribe to the channel and turn on the notifications to be notified of every upload. This is Upstep Financial, and we will see you on our next video. Thank you for watching.